Okay, why don't we make a start? Let me start by welcoming everyone to another CSAE webinar. We've got 81 participants in our virtual room at the moment. We're really very fortunate and thrilled today to be welcoming Dina Pomeranz. Dina is the UBS Foundation Assistant Professor of Applied Economics at the University of Zurich Department of Economics. She'll be speaking to us today about tax collection in developing countries. Before Dina starts, I'm sure most of you know the way that we're running these. As you'll see on the screen, Dina's going to speak for about 45 minutes. If you have a clarifying question during that time, please use the Q&A functionality and I'll keep an eye on that. And then hopefully we'll have some time at the end for more open questions and discussion. And you can either type your question into the Q&A or just raise your hand and I'll try to come to you. Dina, thank you so much for joining us. We'll let you share your screen and start.
I can share this. Can you now see the slides?
Yeah, that's great. Thank you.
Excellent. Well, thank you so much for inviting me, Simon. Simon is a very special person for me because at the very first time as a graduate student that I gave a presentation at a conference, Simon came up to me afterwards and not only had very kind words to say, but gave some constructive feedback that actually substantially improved the paper.
Thank you.
So that's very meaningful for me at the time as a grad student. So it's very nice to see you again here today, Simon.
Thanks, Dina.
So great. So today's presentation will not be technically like in academic seminar where I'm just going to present a paper in progress. Instead, this is more of an overview talk on a couple of things I learned through my research in collaboration with tax authorities and what they may be able to tell us in general about challenges of tax collection in developing countries. Maybe I can say also this talk follows in part an overview article that I wrote with Jose Villalbelda in the Annual Review of Economics. So for those of you who would like to read more details on any of this, as well as literature review of other papers that are related to this, you can find more details there. Obviously, I cannot cover everything in 45 minutes. Awesome. So I want to start with taxation. Who cares? Because maybe you guys, since you actually selected into this webinar, already care. But more broadly, when I tell people that I study developing countries, oftentimes they're very intrigued. Oh, that sounds very social. How nice of you. And then I mentioned that I study taxation and their eyes glaze over and they're sort of, what, why? People are hungry, there's needs of education, healthcare and safety. And why do you study taxes? So if you're not already convinced that this is important, I want to convince you that taxes are really important. Because to execute any of these various functions that I just mentioned, education, health, infrastructure, the state needs to collect taxes. And to be able to police and to have any functioning state. So it wouldn't be wrong to say that no modern state can even exist in the long run without effective taxation. Interestingly, if I said modern state, because if we look 100 years back, even today's rich countries acquired this capacity to tax a substantial amount of the economy only over the last century. So if we see in this figure here, around the 1910s, here we see the United States, the UK, Sweden, and France had very low rates of tax collection compared to GDP, similarly to some of the very low income countries today. So this is sort of a skill that, or a capability or a capacity that states acquire. That's why we talk about state capacity to actually extract taxation in an effective and fair way. If we look today at the map, we see that it's very strongly correlated in the sense that richer countries tend to collect a larger share of GDP in taxes. So that means that in poor countries, the amount of tax collected is extra low. Because on the one hand, we have a smaller GDP, and then of that smaller GDP now, we're also collecting a smaller fraction. So very little resources for the state to run things. So strengthening tax capacity is therefore a key priority for many, many governments in low and middle income countries. To fund infrastructure, public services right now during the COVID-19 crisis, it's a big issue. That tax collections are low, and then in a crisis like that hits, they're getting even lower. So the state is really starved for resources. There has been a hypothesis for a long time and really interesting research, for example, by Jonathan Weigel, showing that it also really affects the citizens' engagement with the state. If the state is funded by oil or aid, it doesn't have the same impact on sort of the social contract between the citizen and the state, where if the citizens fund the state, they feel some ownership that Jonathan Weigel showed actually increases the citizens' engagement and critical pressure on the state, which is important for a lot of development goals. The other issue is that when we have a lot of evasion, then it ends up being that some firms or actors have to pay very high taxes. And in other industries or other activities, there are much lower taxes. And that can lead to big distortions in the economy between activities or actors that are taxed and those that are not. And so these distortions are obviously also an economic problem. And finally, as countries grow, they want to grow less dependent on international aid. And so they want to learn how to raise their own resources. So a key challenge, why is this such a non-trivial thing, is that information about the activities in the economy are not automatically apparent to the government. And to impose any tax, the government first needs to have this information about these taxable transactions. This is particularly challenging for less developed economies because they have less formalization of firms and transactions, and therefore less information about such taxable transactions. Here we can see a historic example of how this is not a problem of today's developing countries in particular, but we in Europe had the exact same issues not that long ago. So this is actually quite long ago. This particular example is from the 16th and 17th century from Denmark. And it's a sort of very pretty example of something that was true all around, which is a lot of taxation used to be collected as tariffs or tolls. You might have heard in history lesson, right, about you have to take entrance fee to get into a city or bridge taxes and things like that. So here in Denmark, they have this nice situation that they had this sound strait where anyone making trade around that region had to go through that strait. And so Denmark at some time collected 2/3 of their taxes from ships that pass through the strait. Why? Because it's very clearly visible who's going through there. You can't really evade. And you can just inspect the goods in the ships to understand how much is being transacted. So the key of this is that information historically has always been a very key ingredient in collecting taxes. So now we're getting to the modern state. And one possible solution to find information has been the so-called third-party information. What is this? This is the idea that a third party gives information about another actor to the government. So now the government knows that this actor had an income. I can give you an example. For example, if you have an income, then your employer will send a paper to the government saying, we hired, so if the University of Zurich hires me, they can tell the information to the government saying, we paid Professor Pomeranz such and such salary. And so if I then show up and say, sorry, I had no income, the government knows that that's not true because they got this form. In the United States, that's called a W-2. The firm actually has an interest in doing so because they can then deduct their salaries from their profit tax. So there's been growing evidence that these paper trails play an important role, both before and after the study that I'm going to present in a moment. Are there any clarifying questions so far?
No, none submitted, so this is fine,
great.
Thanks.
Excellent. So in this talk, I'm going to talk about lessons learned on this topic from some research I did in Chile and in Ecuador. And they study both the potential and the limitations of such third-party reporting and paper trails and their interaction with traditional audits. So this is covering sort of 3 papers, one on Chile, it's called No Taxation Without Information, one from Ecuador called Dodging the Taxman, and then the third one that I already mentioned, which presents a bit of a broader overview and also practical lessons learned, taking tax capacity research to the field. Okay, so let's start. Oh, is that a clarifying question? No, Simon was just waving, so I was not sure. Okay, great. So studying the tax, the VAT. that was a study that we did with the Servicio de Impuestos Internos in Chile. And one thing that I want to highlight in this talk is the really important role and powerful support from researchers inside the tax authorities. So none of this, I started this during my PhD, and this team that you see in the picture, they know me really well because we spent weeks and weeks together, working on this study and trying to see how we can creatively learn new things. And it's such a pleasure to learn from people, from practice about where the real problems are and how we can understand them. So this was a large-scale randomized experiment that we piloted in 2008. At the time, taxation used to be one of those areas where many thought that that's the prime example where you cannot use randomization for taxation. So this was really pioneering work from the Chilean tax department. Chile has been on the forefront for a long time in trying to be innovative when it comes to public policy. And one of the key things, if any of you are also thinking of working with government agencies or big institutions, is you have to sort of find this area of overlapping interest. So you have maybe the demands on policy, what is relevant, what are the questions, where do we have data, and where is their willingness to invest energy and time to do a study. And on the other hand, you have the constraints from the academic side, which are, this should be more generalizable than just Chile. It should be a large enough sample that we can actually take generalizable lessons, and there should be an interest in the academic community to this question. So then you get to this overlap where it's both academically relevant and interesting to the agency. That takes a bit of time, but then is where it's the sweet spot where you can have these really cool collaborations. Okay, so what did we do? This was actually 2 randomized trials where we varied the one thing that the tax authority has complete discretion over, which is who they audit and what to tell firms about it, or taxpayers more broadly. And then we didn't have to do a survey. We actually observed the response of taxpayers in order to study the paper trail in the value-added tax. And we found that taxes that are equivalent in standard economic models, namely in this case, the value-added tax and the sales tax, can differ a lot in terms of information flow and then are no longer equivalent when we consider tax administration as part of taxation and tax economics. Okay, so value-added tax has been thought for a long time to be self-enforcing in the following way. So firms have an incentive to report their transactions with other firms. I'll show you in a minute a picture of how that looks like. And this was, among other things, one of the reasons why the countries have largely adopted the value-added tax. It went from 1990, where it was 47 countries, to over 140 countries today. And in many developing countries, it's actually the biggest tax. So for example, in Chile, it's half of tax revenue that come from the value-added tax. But the actual effectiveness of this hypothesis that this was self-enforcing was unclear because most of the empirical evidence we had at the time was a cross-country comparison. The problem, of course, being that when a country introduces a new tax or has a different tax, many other things might vary at the same time. And so any increase in tax collection at the time of introducing a VAT couldn't necessarily be attributed specifically to the value-added mechanism. So in this paper, we tested the empirical relevance of this self-enforcement, and we actually did find strong evidence of self-enforcing properties. The paper trail led to large spillovers of tax enforcement along the production chain. So let me show you how that looks like. So here we have a little production chain. So we have firm 1 sells to firm 2 sells to firm 3 sells to the consumer. Now the value-added tax base is exactly the same in principle to a sales tax. But instead of the final seller paying tax on the final amount, each production stage, the firms pay a little bit on how much is their sales minus their input cost. And how evasion would work is you underreport sales or you overreport your input cost. Now the VAT has this neat feature that there's this paper trail that makes it harder to do this type of evasion. Because downstream firms, in this case, for example, firm 3, need a receipt to deduct their input cost. So if firm 2 sells something to firm 3, then firm 3 will ask them for a receipt. Now, in the books of firm 3, there's proof that firm 2 made a sale. So that's now very similar to the salary example I gave you before. The same happens when firm 1 sells to firm 2. Where this breaks down is at the last stage. The final consumer, not having to pay VAT themselves, doesn't have any incentive to ask for a receipt. And so there is no paper trail after sale from the firm 3 to the final consumer. So this paper trail chain is also called the VAT chain, which breaks down at the end. So in experiment 1, we try to see, can this work? Is this actually working in Chile in equilibrium? In other words, does the paper trail act as a substitute for the audit probability? And we did this by testing whether increased tax enforcement had a smaller impact where self-enforcement, namely this paper trail, was present. In other words, between 2 firms. So what did we do? We sent, or I'm saying we, the tax authority sent 100,000 letters to firms indicating that they were under increased scrutiny. And so then we wanted to see if there was less of a response on these transactions between 2 firms where there was this paper trail compared to the sales to the final consumer where there wasn't the paper trail. And the letter said, we would like to inform you that in the process of random selection among small and medium-sized firms, your firm has been selected for an analysis. If any irregularities are detected, you could be summoned for an audit. By the way, parenthesis, for those of you again who are thinking of doing this type of research, we tested this many, many times. So I spent several days in the tax office talking to clients who came to the tax office, giving them different drafts of the paper and asking them, what would you do? What would you think if you got this? And are there any words you don't understand? And that was really helpful in making the message say exactly what we intended it to say. Another thing that the letter said that is not printed here is there's no point in coming to the tax office now. There's no additional information we can give you. And notice that it says random selection. Why? Because in the first drafts, almost every firm that we said, what would you do, said I would go send my tax accountant to the tax office. Now imagine if 100,000 tax accountants had showed up at the tax office, it would have been a disaster. It's a small country. So the fact that it's randomly selected, so there's nothing you did wrong to get this, and that it says that there's no additional information was really instrumental in the practical side of the study. Okay, so what happened? First of all, firms did take the letter seriously. After the letter arrived, tax collection immediately, tax payments immediately went up. The median went up by about 12 percentage points. So this is a key ingredient for the study, right? If nobody had taken the letter seriously, we couldn't study responses. Also, if there was already perfect compliance in Chile, presumably nobody would have increased either. So we're in this place where there is evasion, but it's not so rampant that nobody cares what the government says. Now we can use this to study the paper trail. So we study, does this additional enforcement have less of an impact on transactions that are already subject to the paper trail? If so, we would expect a smaller response on transactions between firms than on transactions with final consumers. This is exactly what we find, right? So on the left hand, you see sales to the final consumer that went up a lot. And on the right hand, you see intermediate sales, which are sales to other firms that didn't go up. So what this means is that when there was a paper trail, there was, if anything, if you get audited, an audit could detect more problems. So the fact that you're responding less to an audit threat on intermediate sales suggests strongly that before already you had been cheating less on these transactions, and firms have been cheating mostly on firms to the final consumer. And so when they get the warning where they have margin to improve is in the sales to the final consumer. So this suggests that the paper trail was highly effective. Any questions on this part of the study?
None submitted so far.
Good. Okay, great. So now we're getting to the second part of the study, which was to try to understand, is this really because of this particular mechanism? We could also imagine, as economists, we're great at that, at coming up with other explanations why firms might respond differently on transactions to final consumer than transactions to other firms. Maybe the way they understood the letter was more about final transactions. Many things could vary. So in the second experiment, we really try to get at the mechanism behind this finding. So here, we are looking to see this directly, the spillover up the production chain. This started with a subsample of firms where the tax authority thought it was likely that there was evasion. How did they think that? It was firms that every year, consistently, these firms reported losses, but they never went out of business, right? And so either they are like super hyper optimistic firms that every year think next year is the breakthrough and they're losing money year after year, or more likely, they're just underreporting a lot their revenue. So to those firms, the tax authority announced to half of them, it's a sample of 5,000 firms, half of them are told that they will be audited for sure in 6 months. The other half was not informed about anything. And then we didn't look at what happened to those firms, but what happened to the trading partners of the firms who were told that they will be audited. So what happened when if I were one of those cheating firms, got a letter saying that I will be audited in 6 months, my supplier started paying more tax, but not my clients. So it's not just that we talk about it, oh, I got this letter, I guess they're looking, let's all be careful. No, it has this clear directionality. When I know I'm going to get audited, I'm going to want to have all this proof for my deductions in my papers. So I'm going to consistently now ask for receipts from my suppliers. Maybe before I didn't need them because if I don't pay any taxes, I maybe don't need additional deductions. For my suppliers, for my clients, there's nothing changing. I'm not asking them for more paper trail or anything. And so we see exactly those firms that I'm now asking for receipts from, they are now declaring more sales. And so this really shows how the mechanism underlying the fact that we found that for those firms who seem to be more compliant, there was less cheating going on those transactions between two firms. So in other words, when firms started complying, it increased enforcement up the VAT chain. So there was a spillover effect from telling me that I'll be audited and actually multiplied by getting other firms also to comply because now I ask for receipts. So the implications of this is that the value-added tax seems to really exploit the structure of the supply chain in a clever way to facilitate monitoring and increase tax compliance. And so forms of taxation that leave a stronger paper trail have advantages over other forms of taxation. So for example, value-added tax versus sales tax that we see here, but also there's a lot of discussion now about digitalization in a lot of developing countries about, paying by phone or electronically, whether the government should collect this information, so to have more of a paper trail. The other thing that's really important, and we'll see in the second study, is that it's not actually self-enforcing. It's actually the injection of deterrence in experiment 2 that made the paper trail effective. So it's really the combination of information with enforcement that leads to effective tax compliance. Okay, any questions about the Chile study before we go to the Ecuador study?
No questions at the moment, but we can have a broader discussion towards the end. And we've got about 20 minutes left, if
Perfect.
that's okay, for the presentation.
Excellent.
Before we take questions.
Excellent. So we're perfectly on time. So now we're going to, this was a case where we can say, okay, in Chile, accepting this sample of suspicious firms, overall, seems a country with high tax capacity. We find that big deterrence effect where the paper trail is present. In the first study with 100,000 representative firms, we found that much less cheating where the paper trail is present. Fantastic news. Everyone switch on paper trails and we got rid of tax problems, right? As you know, as development economists, every time we think we have found a magic solution to a big problem, it's usually not that simple. If it were that simple, governments would have already implemented it, right? So in the follow-up study in Ecuador, we see exactly that. We see when a country tries to start this. So as background, Chile was one of the first countries to introduce the VAT in the world. And they had, this was like the steady state long run where everything ends up working fine. So here we have Ecuador trying to start to introduce third-party reporting in their tax enforcement. And we see some of the challenges that can come up. So again, great collaboration with the research department in the Ecuadorian tax authority this time. Andrea Lopez actually, as part of this collaboration, ended up applying for graduate school and has just finished and is now a professor in Colombia. That was one thing that also came out of this collaboration. So another thing that sometimes can happen is we can create more pipelines into the academic research from partnering with these excellent experts from practice. Good. Okay, so what did we do? So as I mentioned, Ecuador had recently acquired the capability to electronically cross-check third-party information at a large scale. And so here we wanted to study whether this third-party reporting and the electronic cross-checks solve the problem of developing countries' tax enforcement, which, as spoiler, I already told you, it doesn't solve it automatically. So what did they do? So the tax authority collected information from the VAT and from other sources, for example, credit card payments, to cross-check that with firms' reported revenue. So they gathered all this information. What did third-party firms report? What did your credit card company report that you had sales through the credit card where you received income? And so for every firm, the tax authority could construct a difference with how much the firm declared in revenue compared to how much the tax authority knew from third-party sources that the firms should have declared at the minimum. And then the tax authority took the firms with the largest discrepancy and notified them that there was this discrepancy and requested they amend their declaration because the government knows that they have not reported all their sales. Some challenges in this setting. Third-party reporting in general is partial. So it's here an underestimate of the total amount, for example, of sales, because you have the third-party reported sales, but there might be other sales in addition that the firm has that are not third-party reported. Second challenge, other aspects of the tax system remain relatively weak. So what you do if somebody cheats, how do you take them to court? How many auditors did you have to go check? So the question was, will this still work? Here's the letter again. This is so different a bit from the Chilean one because it says after careful, this is, by the way, a letter that we were not involved in. This is a natural experiment. They did this before we started evaluating it. After careful of your firm in fiscal year such and such is larger than the revenue reported by your firms in the income tax return. And in 2008 wave, they didn't actually tell them how much. They just said, we know you're underreported, hoping that the firm would get scared and report more even than the tax authority knew. In later waves, and you'll see soon why, they told the firm how much they knew. So preview of results. A large share of firms did not respond to the message at all. Government tells you, and these are not tiny firms, huh? There's like $400,000 in revenue missing. Nothing, crickets. Second, among those who responded, many firms increased reported sales, but also reported costs. So here we have 109 million in additional reported sales that were declared. Fantastic. This was the part that the tax authority was expecting and hoping for. 101 million in additional costs declared. Tax authority did not expect that. So actual tax collection was 2.3 billion additional dollars. So now that's not nothing. Ecuador's a not a very high income country, small country, you could build a bunch of schools with that. This definitely covered the cost of installing the system, but very far away from the $109 million in additional revenue. What happened? So then we conducted a series of interviews and focus groups, both with tax officials, with auditors, with firm owners. We went to the business school and said, how do you deal with the burden of taxation? It's so horrible. How do you evade it? With tax lawyers, you pay tax lawyers. How would you advise us to deal with this type of notification? And consistently, one message came through is that firms perceive that their audit probability is higher if they have low declared profit rate. So they think, if you declare $100 in profit out of $100,000 in sales, that would be less credible and more suspicious than if you declare $100 in profit out of $1,000 in sales. So you want to make your firms look profitable in the tax declaration to raise less suspicion. So as a result of that, prior to the intervention, some firms underreported not only revenues, but actually underreported costs, which is a priori surprising, because remember from the value-added tax, right? Like you want to take all the deductions you can, because that lowers your tax bill. But here now, firms, in addition, they want, for a given amount of taxable profits they want to declare, they want to look as if they're small firms having that profit. So they can kind of fly under the radar of the tax authority and look like a small firm with a relatively high profit rate rather than a large firm with a relatively low profit rate. So here's what we see then more specifically what happened in the data. In the year to the right, 2008, where the tax authority didn't tell the firms how much they knew, sadly for the tax authority, firms actually underestimated how much the government knew and only adjusted to about a third of what the government knew. So that's why afterwards the government told firms, here's how much we know that you had, at least in revenues, and firms adjusted to a bit over 90% of that. Irregardless of whether they had been told the amount or not, the adjustment in costs was essentially 100% of the adjustment in revenue with some noise around it. So this clearly looks like cheating, because it's not like firms like go back over their books and they find, oh, I forgot some costs. Because you see, they match it exactly, even in the case of 2008, where they adjusted their revenue much less, they also adjust their costs less, right? Additional indication that at least some of these additional costs were fake. So certainly some of the costs that were put on the books were underreported costs before, so they're true costs put on, but some of these probably were fake costs. We see this here. The most likely adjusted item is the one that's hardest to audit. So first of all, firms disproportionately adjusted costs on line items that were more difficult to verify. So within line items, more adjustments were made on administrative costs. The adjustment was other administrative costs. So it's the easiest to make up. So what does this mean? So on the one hand, firms were probably underreporting. And now that they are told they are putting that on the books, which to some degree, maybe it's fine. We get a stronger paper trail. Now people are taking more deductions. It's similar a bit to the experiment tool we saw in Chile. But on the other hand, here we come into the crux of the limitations of the paper trail, is that you can just fake deductions, make up something, you know, hope the tax authority never comes. And if they want to now check that you cheated, they have to send again an auditor, which defeats the whole purpose of what the tax authority wanted to achieve, you know, by doing this electronically, that you don't have to send an auditor. You can do third-party reporting. You click a button, you send, you know, hundreds of these notifications, and firms comply. That works well when you have something that tends to get underreported. The firms reported 1 million in profits. The government knows they had 1.5 million. There's a gap. It doesn't work well when you have something that tends to get overreported, because the third party gives you a lower bound. Now you have a lower bound of cost. The firm reports more costs. You don't know really if those costs are fake or if those costs are real based on the third party information. You have to go audit again. So therefore, as soon as there are deductions involved, third party reporting alone is not sufficient. And that's where it's so important to strengthen the other parts of the tax system. Which brings us to the takeaway of this Ecuador study. So introducing tax enforcement on third-party cross-checks was partially effective. So discrepancy notifications did increase the declared revenue. But the effect of this can be very limited when taxpayers can adjust on other margins, particularly when information is incomplete, which is the case almost always in developing countries. So to be most effective, third-party information probably should cover the whole base. And sometimes that could be even an argument that we go to a turnover tax, even though we all know for tax reasons that's often much less efficient than a profit tax or a value-added tax. But for tax enforcement reasons, you may want to do this trade-off and actually have a turnover tax, because there you don't have these deductions that are much more difficult to track with third-party information. Also, this means that finding no evasion on third-party reported elements shows the entire impact of a reform. So you need to look at the global effect for a taxpayer. You know, if you just looked at revenue here, or you just look at one type of tax, but then firms can cheat more on other tax. This is a bit similar to crime displacement or multitasking of incentives, where you don't want to have firms. You don't want to look only at the activity that you enforce. You want to look at tax payments of the entire tax payments of the taxpayer. What does this imply? So even if direct effectiveness of third-party monitoring is limited, there might still be some other benefits. First of all, this now allows focusing audits on non-third-party reported margins, such as costs, so you don't have to go audit so much the revenues. Also, it may be a dynamic process. Right now, we saw firms reporting more costs. They might now ask for more receipts, similarly to what we saw in Chile. Then the other firms might report more revenue, and this might be a positive dynamic effect over time. But it also implies that Ecuador probably went too much too fast, because they sent notices to 9,000 firms, and tax preparer immediately see there are lots of notices, and it's immediately clear that the tax authority doesn't have the capacity to audit 9,000 firms. Now imagine if instead they audited 50 firms in year one, and everyone who had this weird suspicious behavior that completely offsetting everything with costs or not responding to the letter would be audited. So then word gets out that this is a notice you should take seriously. So next year, maybe you send 100, 50 are gonna already comply because they know this is serious, and you then only have to audit 50 more. And gradually you can get it up to an equilibrium like we have it in rich countries, where you can reasonably expect that if you cheat in an obvious way, the tax authority will come, because not that many people are doing that, and so they have the capacity to do that. The other implication is the developing countries still need to strengthen their auditing and enforcement capacity. You can't just say, let's switch on third-party reporting, great, we're all done. You have to have the backup of credible enforcement. Otherwise, you have this situation where the majority of firms don't even respond when they get a notice, knowing full well that there's not the capacity to send an auditor to everyone who doesn't respond. So to conclude, takeaways on third-party reported paper trail. So limited information about taxable transaction in the economy present a big challenge in many developing countries. Used to be a big challenge in the rich countries too, but are now less so. Enforcing in that sense, without effective deterrence behind it. So third-party reported information can play an important role for tax collection, but it's not a quick and simple fix. It's an important gradual process of building the web of information and deterrence power, and strengthening traditional enforcement capacities remains crucial. So I think I have like a minute to talk a bit more big picture. So I spoke now with you about paper trails and specific studies I did, but much more broadly, I think the collaborations between researchers and experts from tax authority can provide really mutual beneficial outcomes and insights. Here the tax authorities collected a lot of additional tax from doing the study, learned a lot, actually also learned a lot of the methods that we did together and are still using them. So at least that they tell me, this was like a very satisfying and successful experience for the tax authority. At the same time, there's lots of different research we can do. So here we looked at these taxes, then there's more research that just strengthening audit capacity, how to do the audits right. This is a project that I'm currently working on in Chile with Stefan Lichik and Maria Paula Gerardino. In Kenya, we're working with the Kenya Revenue Authority with Lorenzo Casaburi to study the timing of taxation rather than just looking at profitability of firms, to actually look at cash flow. And finally, we can use tax data, in this case, the value-added taxes, to study other questions, right? Because it's amazingly high-quality firm data, especially if you get into development stages where the compliance is relatively comparatively reliable. So we have an ongoing set of projects where we're using this VAT data from Ecuador that we used for this evasion study to actually study firm development and how trade affects inequality and questions of this sort. So I just want to encourage everyone who's thinking about doing research with governments. It's a big time investment. You build a coalition, you have to have many people in the organization agree with you, which is very different. If you do a lab in the field experiment, you go there, you set it up, you run it, you're the boss. Here, you're not the boss. So you have to get other people excited. On the other hand, it can be very rewarding. And if you have a good relationship, multiple papers can come out of a single collaboration relationship. With that, I think my time is out and we can think about more broad questions to discuss.
Thank you so much, Dina, for a fascinating talk. So let's take a round of questions, and maybe let me go for the first one to Adrian Lees. We'll get, if you don't mind unmuting, you can ask the question directly, and then I'll go to Mohammed Mekki. So Adrian, have you got the question? Maybe let me just read the question. The question from Adrian is the following. On the problem of firms repeatedly declaring a tax loss or only a very small tax liability, which might indicate cheating, some countries have responded to this by introducing alternative minimum taxes, something like 1% of gross turnover. And basically the question is about your thoughts on that.
I think that's 1% of gross turnover comes close to implicitly what the firms in Ecuador were sort of expecting, right? If you have less than 1% of profit rate, then you are at risk of being audited. So it becomes similar, like the turnover tax, right? That I was saying also that Michael Best and co-authors recommend in some settings. And if you really can't get better information, you might as well have a minimum tax that is a turnover tax. If it's too high, it becomes a problem because like some industries may not have that high of a profit margin. But certainly in some cases that's much better because you don't have enough information to actually tax profits.
I see, thanks. So let me ask Mohammed Mekki, if you can unmute and ask your question, and then I'll come to Noam Angrist.
Hi, Dina. Thanks for a fascinating presentation, especially this conversation about what you target profit turnover. And the explanation that you give about why people were underreporting costs initially makes a lot of sense in terms of wanting to look smaller and have a higher profit margin. But just wondering about the particular context in which you're working, was there a tax loss carry forward in Ecuador? Because that's something that could potentially reduce the incentive for people to understate their costs, right?
Yes, that's true. So it's in Chile, you can fully carry this forward, but in Ecuador, it's quite limited. You can carry forward some of it for some amount of time, but not infinite and not forever. So that is true. So with regards to wanting to give an incentive to also always ask for a receipt, in principle, that's the only consideration. You would want to have the ability to forever carry over all of this. A great question, thank you.
Thanks, Mohammed. Noam, if you can ask your question, and then we'll go to Rossa and Gabriel. Lots of questions. Sorry, Noam.
Great.
Thank you so much for a really fascinating talk. I'm just curious, what part of the motivation that you started with was the high share of informality in developing countries. I'm just curious what your take on what the implications of this might be for that, either for dealing with informality in general, or maybe the transition from informality to formality, if there's any scope for using some of these insights to manage that transition well. Thank you.
I guess, let me think about this. So first of all these studies are obviously with formal firms in the sense that they are registered. Otherwise, they wouldn't be in the tax system. So the completely informal firms are not in these studies, but even in registered firms, you have a lot of transactions off the books. And these taxes in this study touches on those. The informal firms behave very similar to a final consumer, that they pay the value added tax because it's part of the cost of the final product, but they don't remit taxes directly to the government. So one trade-off that's always happens with taxes, if the tax burden from formalizing is too high, you may deter formalization. There's always this trade-off that you don't want to sort of kill firm activities from overtaxing. So it's in a way a much starker trade-off than rich countries have, because it's not the chance that CVS is suddenly going to go underground or close shop for these reasons. So that is a concern. Now, I think the informality is a bit similar to appearing artificially small, that it can actually have a real effect that it makes firms to actually want to be artificially small, not just appear artificially small, which can be economically really ineffective. And once you are the size of CVS, that's probably a bad example, because even if you're the size of CVS in Kenya, you can't just go underground. So you may not want to be the size of CVS. You want to stay like a corner store pharmacy. And that would be a bad incentive, and there's a real trade-off there with economic development and taxation.
Thanks very much. Rossa.
Thanks very much, Dina. Thanks, Simon. My question, I think, is more relevant to the VAT study. And I was wondering whether you can detect any kind of equilibrium effects of the experiment. So, for example, we might think that there might be kind of small increases in prices consumers face, but there might also be distortions in competition. So do you see any evidence that people are switching suppliers if they think their supplier is more likely to be audited or anything like this? And this might be relevant to thinking about what would happen as we scale up the policy as well.
Yeah, these are very interesting questions, which both of them, unfortunately, I cannot answer with the Chilean data. So first of all, I don't have prices. And typically tax data doesn't have prices. So Joanna Naritomi, I believe, has like a really cool data set from Brazil where she has a data set with actual prices of products that firms sell. But it's very rare to have those. So that would be really interesting to see the pass-through and how the pass-through happens in the value-added tax enforcement. With the network, we don't have the network data in Chile at all, but it would be potentially something we could study in the Ecuador case, whether like tax enforcement on one firm changes the network and leads firms to interact with another firm. What we couldn't observe is if they just, so I'm thinking out loud, if they stay with the same firm and make the transactions under the table, we couldn't observe that in the data, but we would then see that their total inputs or sales, change. Versus if the total amount stays the same, but it's now with other firms, that would suggest more substitution to other firms. As far as I am aware right now, nobody has analyzed that yet, but there might be work in progress that I'm not aware of, but I think that'll be very interesting to analyze how enforcement can lead to change the production chain. Actually, now remember, there's one really cool paper from Brazil that looks at production chains and finds that in sectors, this is not an RCT or an intervention, but they find that production chains, in industries with the value-added tax, formal firms trade with formal firms and informal firms trade with informal firms. In the industries that don't have that tax, formal and informal firms trade with each other in a more mixed way, which would sort of show you the end result of that kind of substitution effect.
Nice.
Thanks so much. So let's go to Gabriel and then we'll go to Ken Opolo from Georgetown. But Gabriel, you first.
Thanks. Thanks, Dina, for a very nice presentation. So my questions are related to Ross's and Noam's actually. So one thing would be this movements across suppliers, like when one of your main buyers is audited with higher probability, if you see the shifts, like you basically answered this already. The other thing that I was wondering about, if these upstream effects also change with the size of the firm. So actually, if you're a smaller firm, you're more easily, your suppliers might easily shift away from you if they want to evade more. And if you're
say that again with the size. I thought
if you're a big buyer, say in the supply chain, and you're now audited with higher probability, your suppliers might have a harder time shifting away from you.
Yes.
Right. If you see these effects in the data or not.
So unfortunately, I can't see the shifting at all in the data. I think it's a very interesting question. But I don't have any information on that. But it seems like what you're saying, that if you have market power, people cannot shift away from you.
But you could see the strength of these effects depending on firm size, right? In terms
so
of.
What I found is that it was the case that bigger firms responded much less than smaller firms. In part, that was driven by the fact that bigger firms were more likely to be business to business and sold less to the final consumer. But in part, I also think, so very large firms were not in the study. This was small and medium. And the very large firms, the way they evade taxes is with complicated tax avoidance schemes and not necessarily by not giving a receipt, at the checkout. But we don't have the very large firms in the study. We certainly did find that the smaller firms responded more.
Okay, and the other thing I had in mind is exactly the paper you were mentioning by Shakeman and Audio De Paula on the informality and formality of the supply chains.
Very cool paper. I was very inspired by that also when I did the research.
And it would be really cool to see this network
macro,
effects.
I believe.
Yeah, exactly.
Yeah, so, it's very cool.
Yeah, no, so these were the questions. Thanks.
Thanks so much. So let's go to Ken Opolo from Georgetown. I think if you unmute yourself, then you can ask the question, Ken. Thanks.
Yeah. Hi, Dina. Thanks for your presentation. Quick question, also related to the previous two questions. Basically, you could also imagine that the nature of financing may impact the legibility of these small farms. So do you have sufficient data to see whether farms that depend on bank financing that can be traced by the government are more likely to be transparent compared to farms that raise capital through other means?
So I have no data on that at all. In Ecuador, they have bank data to construct a third-party information. So one benefit, if you have transparency laws in banking, is that the tax authority can see some of the transactions that go through the banks. Chile has tax secrecy for the banks. So my research can't really speak to that. There's another paper from Greece that seems to show that banks are sophisticated enough that they adjust so one reason you would think is that firms don't cheat is that if you report very low profits, you may not get a loan. Yeah. Apparently, banks in Greece at least adjust for that. And so they know exactly what is a typical profit for an evasion rates by industry. And so the paper can sort of estimate the evasion by looking at how the bank assesses the profitability of the firm versus what firms actually declare, and they can sort of get an estimate of evasion for that. So unfortunately, it would be good for tax authorities if banks naively took the reported profits amount from the tax declaration and gave credit based on that. But it seems like, at least in Greece, that the private sector lenders adjust for that to some degree. I know that doesn't answer directly your question, but unfortunately, my own research can't measure that.
Great. Thanks very much. Thanks very much, Dina. I think we're coming to the top of the hour, so I think this is probably a good time to thank you and thank all of the participants. I apologize to those of you whose questions I couldn't get to, but hopefully there'll be an opportunity to follow up later if you'd like with Dina. Dina, thank you so much for joining us.
Thank you for having me. This was very exciting. New format. We're all learning, huh? New research communication. So thank you very much for the opportunity.
Oh, no, thank you. And let me say to everyone, please keep your eyes on the CSAE Twitter feed. Just to foreshadow, I anticipate that next week we'll be starting at 3 p.m. UK time. And we'll have David McKenzie, who'll be talking about a randomized control trial on management practices and the boundary of the entrepreneur. But we will advertise that through the normal channels, and we'll look forward to seeing you then. Thank you all for joining, and thanks again, Dina, for a fascinating presentation.
Thank you so much.